Every time you earn a mile or cash back, the merchant loses 1.5% to 3.5% of the transaction value. This fee, called interchange, is the single largest non-labor cost for many retailers. It is not paid by the consumer directly, but it fundamentally alters retail pricing structures. The system is designed to incentivize high-spending consumers while shifting the cost burden entirely onto the seller, who must accept the fee to participate in the card ecosystem. This hidden tax funds the entire rewards economy, creating a massive wealth transfer mechanism from merchants to card issuers. Interchange is a fee paid by the merchant's bank, known as the acquirer, to the cardholder's bank, the issuer. This payment compensates the issuer for the risk of fraud, the cost of funding the transaction until settlement, and the operational expenses of maintaining the card program. The card network, such as Visa or MasterCard, sets the default interchange schedule, acting as the central clearinghouse and rule setter. Crucially, the networks do not collect the bulk of the interchange fee themselves. They facilitate the transfer between the two financial institutions. Interchange fees are highly variable, calculated based on a complex matrix defined by the card network. The fee typically consists of a fixed component, often 10 cents, plus a percentage of the transaction value, ranging from 0.5% for standard debit cards to over 3% for premium rewards cards. Key variables determining the rate include the type of card, whether the transaction is card present or card not present, and the merchant category code. Higher reward tiers, such as World Elite MasterCard or Visa Infinite, command the highest interchange rates because the issuer needs more revenue to fund the enhanced benefits offered to the cardholder. Merchants do not pay interchange directly. They pay the merchant discount rate, or MDR, to their acquirer. The MDR is the total fee deducted from the transaction settlement. This rate comprises three main components: the interchange fee, the network assessment fee, and the acquirer markup. The acquirer markup covers processing costs, risk management, and profit for the acquiring bank. For a typical 2.5% MDR, interchange often accounts for 80% or more of the total cost, making it the dominant factor in merchant pricing negotiations and profitability. Interchange revenue is the primary non-interest income stream for card issuers, especially those focused on premium products. This revenue stream directly funds the generous rewards programs, including airline miles, hotel points, and cashback, which are essential marketing tools to attract affluent customers. Furthermore, interchange covers the cost of fraud losses, which are borne by the issuer in most card-not-present transactions, and the operational costs of customer service and technology infrastructure. Without high interchange, the current competitive landscape of premium rewards cards would be economically unsustainable for the issuing banks. While issuers receive the bulk of the interchange fee, the card networks impose separate assessment fees on the acquirer. These fees are typically a small percentage of the transaction volume, around 0.10% to 0.15%, plus various fixed fees for services like cross-border processing or authorization. Assessment fees fund the network's core infrastructure, including global transaction routing, security protocols, and brand marketing. These networks also generate significant revenue by selling value-added services, such as fraud monitoring tools and data analytics to both issuers and acquirers, further monetizing the payment flow. Governments have intervened to limit interchange fees, arguing they distort competition and harm small businesses. In the United States, the 2010 Durbin Amendment capped debit card interchange fees for banks with over $10 billion in assets at approximately 21 cents plus 0.05%. This regulation significantly reduced issuer revenue from debit transactions. Similarly, the European Union capped consumer credit card interchange at 0.3% and debit card interchange at 0.2% across the European Economic Area, forcing a fundamental restructuring of European card reward programs and shifting focus to annual fees. Large business-to-business merchants utilize Level 2 and Level 3 data processing to qualify for lower interchange rates. By providing enhanced transaction details, such as tax amounts, invoice numbers, and customer codes, they reduce the issuer's risk assessment, often lowering the fee by 50 basis points or more. Furthermore, technological advancements enable dynamic surcharging, where merchants pass the exact cost of the interchange fee directly to the consumer. This practice is regulated by network rules and state laws, requiring sophisticated point-of-sale systems capable of calculating and displaying the fee differential in real time to maintain compliance. The consumer ultimately pays for interchange fees through generalized price inflation. Merchants must incorporate the cost of the merchant discount rate into their overall pricing strategy for all goods and services, regardless of the payment method used. This phenomenon, known as fee shifting, means cash payers subsidize the rewards earned by credit card users. The current system creates a wealth transfer mechanism, favoring high-income consumers who maximize rewards usage while imposing a hidden, systemic tax on the entire purchasing public, regardless of their payment choice.